In this video, we're going to explain task 1 from the first sample assessment for personal tax. So in task 1, this is about the rules that underpin tax and just covers a variety of the theoretical ideas for the tax system. Let's have a look at part A. So there are 5 principles which underpin taxation systems. And we need to state and define any 3 of the 5 principles for the 6 marks. So notice there are 6 marks available, so that means we're going to get 1 mark for stating and then a second mark for defining each of the 3 principles in our answer. So the first of the tax principles is that of neutrality. So this is defined as allowing equitability between different forms of businesses. So we want the tax system to be neutral so that if 2 similar businesses do their tax returns, they should pay similar amounts of tax, and that one business shouldn't have any favourable treatment over another business, or even one individual should not have any favourable treatment over another individual. The second principle is that of efficiency. So this is minimising cost to businesses and governments of administrating tax. So the tax system is a method for governments to raise money so they can spend it on healthcare and education and so on. But if the process of raising that income is a burden for the government and for the businesses and individuals who are paying tax, then it could be that we're not really going to have a very good system and we're not going to collect money in a very good way. So we want to make sure the tax system is as easy for everybody to use as possible. The third principle is that of certainty and simplicity. So this is defined as making the tax rules clear and simple to understand. So we've got 2 ideas here. So in terms of simplicity, we want to have simple rules so that individuals can apply those tax rules without any excessive cost of having to get experts to help them. So it should be simple for the users to use. But we also have the certainty that when we apply those rules, we're going to come up with a number. So when individuals calculate their tax for themselves, then the number they've calculated is actually the number they need to pay. And they don't have to worry about having to pay a different amount because the system isn't working properly. Now we only need to do 3 principles for our answer, but let's revise all 5 of them for the purposes of this video. So the 4th principle is that of effectiveness and fairness. So this is defined as taxation being the right amount at the right time. So we need to have an effective system so that people pay their taxes on time, because if they're late, that could cause problems for the government, couldn't it? And similarly, the government needs to pay rebates on time as well, and it needs to be fair so that everybody follows the rules appropriately, they pay the right amount of tax, no one is getting any special treatment or is being punished in any particular way. And the 5th principle is that of flexibility, that the taxation system should be able to keep pace with how the world is changing. So there may be new ways of making income, there may be new ways of administrating businesses, so the tax system needs to be able to keep up with that. So for example, lots of people are using the cloud now to do their accounts online, and the tax system has adapted to allow people to do that as well, and they don't have to submit a paper document. Let's move on to part B now. You work in an accounting firm and you have a client who is resident and domiciled in the UK. A taxpayer's residence and domicile have important consequences on the treatment of their UK and overseas income. There is a statutory residence test which considers whether someone is automatically resident, and if they're not, whether they're automatically not resident. So you need to work out the residence based on those tests. And a person is domiciled in the country in which they have their permanent home. A person may be resident in more than one country or have dual nationality, but under UK law they can be domiciled in only one country at a time. So we're told in the question the client has always declared all UK income to HMRC. He has started receiving rental income from an overseas property. The client has emailed you stating that as the property is not based in the UK, he thinks that he does not need to declare this income to HMRC. The scenario tells us that this client is resident and domiciled, and therefore all worldwide income and gains are taxable in the UK. So this overseas property income needs to be declared to HMRC. It doesn't matter that the property is outside the UK. In part 2 of the question, it asks us, explain your actions if the client refuses to make this declaration. So notice it says explain, simply not state the actions. So we need a little bit more detail here to make sure that we get our marks. Notice there are 3 marks available here, so you need to make sure you write enough to get those 3 marks. The first thing we need to recognise is that there is an ethical problem here. This client is doing something illegal. They want to evade this tax, and therefore we don't want to work with them anymore. So we need to protect ourselves, and therefore our first action is to communicate with the client in writing, so we have that documentary evidence to support the actions that we're taking. We don't want to be associated with this client if they're going to behave illegally, and therefore we will need to cease acting for them. If we continue to work for them, then it will damage our reputation. As we stop working for the client, we'll need to inform HMRC that we have ceased acting for them. So this is to make sure that we're transparent, that they know what's going on. However, to maintain confidentiality, we cannot say why we are not working for them anymore. So we cannot disclose the reason why we're ceasing to act for them. So it'll be up to HRC to talk to the client and find out what's going on.